All right, welcome to AskGAOLive, the U.S. Government Accountability Office's web chat project. My name is Jeremy Clucci. I'm with GAO's Public Affairs Office. I'm here today with Matt Scire, a director in our Financial Markets and Community Investment team. I want to start off by thanking you very much for joining us. This is our third web chat. We're doing this as an opportunity to engage with you, get questions from the public, and provide you answers in real time to your questions about our new work as it comes out. Today we're going to be discussing federal efforts to help homeowners struggling to keep their homes. Matt's team led work on a report that was issued last week. It's GAO-12-296. It's available on our homepage, gao.gov, if you want to download it. And for today's chat, we're going to start with an introduction from Matt about the work, and then there's an opportunity for you to submit any questions that you may have about it. There are a few ways for you to do that. You can do it over email by sending an email to askgaolive@gao.gov. You can submit your question over Twitter. Just use the hashtag #AskGAOLive, or on Ustream where you're viewing this. To your right of the screen, there should be a chat box. You can enter your question there, and we'll find it there as well. So please feel free to submit that. And without any further ado, Matt, I'd like to open it up to you. I'm hoping you can start by giving a brief introduction to this topic, foreclosure mitigation efforts by the federal government, and talk about why GAO did this study.
Okay, I'd be glad to. So GAO has undertaken a number of engagements taking a look at the Home Affordable Modification program that Treasury operates, and a lot of folks might be familiar with that. It's an attempt to help borrowers who are struggling with their mortgages. We thought we'd follow up on that work and broaden it to look at the federal response more generally. So this engagement takes a look not only at HAMP, but at other federally sponsored efforts to mitigate foreclosures. And we do several different analyses. We try to take a look at where the mortgage market is and assess the extent to which borrowers are at risk of foreclosure. We also take a look at and catalog the federal efforts that are underway and present information on ways that those efforts could be improved. We have a few slides that we could present here. The first one is one in which we take a look at what's happening with defaults and foreclosures. And by the way, if you're having difficulty reading the slide, it's in the report, so I recommend that you take a look at it. So here we're showing defaults and foreclosures, and the message is that we're still at very high default and foreclosure rates. Overall, default meaning loans that are 90 days or more past due, and foreclosures meaning the home is in foreclosure. Those together are about 8% of all mortgages, and this is as of the end of last year. That's near a historical high. House price, not shown here, but other sort of indicators of stress in the mortgage market are house price declines. We present information in the report there. So for example, in the last 5 years, you had 32% decline in house values. We also present information on where homeowners are in terms of the equity in their homes versus mortgage debt. And for the first time since data were collected in 1945, in 2006 and 2007, we had the situation where mortgage debt exceeded homeowners' equity nationwide by a sizable amount, by $3.7 trillion. So that first graph is telling you that we're still having trouble in terms of foreclosures and defaults. The second graphic is our attempt to try to lay out and show the amount of activity from federally sponsored loan modification efforts. And what you'll see here is the second quarter of 10 was the peak in which the federal government was providing support to through loan modification. It also is giving you a distribution within the graphic of the amount of loan modifications that came from HAMP versus those that are done by the GSEs, Fannie Mae and Freddie Mac, FHA, and VA. And what you'll see in this graphic is that HAMP is the largest of the federal efforts. It's important to note that over half of those HAMP modifications were actually done by the GSEs. And then the last graphic is a map which is giving you a sense of where at-risk borrowers are located, or the proportion of borrowers within each state that we estimate were at risk of foreclosure. And here we used a national data set, and we were looking at characteristics such as whether or not the loan was 60 days or more past due, or if it were not 60 days past due, whether it had two or more other characteristics such as high LTV ratios, that's the loan to value ratio, or had high interest rates, or had certain features at origination which were risky. So the thing to take out of this graphic is, there's some states really stand out here. Nevada, Florida, as you might expect, had high proportions of borrowers who are at risk of foreclosure. Nevada at 40%, Florida 29%. Michigan was also high at 22%. So again, and all three of these graphics are in the report.
Great, thanks a lot, Matt. Hopefully the resolution on the images was all right, that you could see the numbers, but as Matt mentioned, GAO-12-296 on our homepage, and contains all these figures and others. So with that introduction, we're going to open it up to any questions you may have, and we have one here to start. Matt, this question came in via email, and the person asks, what are the key differences between a loan modification and a loan refinance?
Well, so a loan modification does not require the creation of a whole new loan, whereas a refinance does. That's the principal difference. And the loan modifications that are being done today generally are looking to reduce the payment on the mortgage, but it does this through modifying certain terms and conditions in the existing mortgage. The existing mortgage stands. With a refinance, the objective there also is to reduce the borrower's monthly mortgage payment, but it's with a whole new mortgage.
Thanks for that. Is there one between the two that the federal programs that you looked at are doing more of?
Well, right now, I think you're seeing more activity in the loan modification space, though refinance is really picking up. There's one program in particular in the refinance area which has had a lot of activity, and that's the Home Affordable Refinance Program. This is one that's undertaken by the GSEs, Fannie Mae and Freddie Mac, and it's had a considerable amount of activity.
Thanks. This next question also came in via email. It's from Stephen, and he asks, was everyone who asked for help from the federal government given help?
No. So there are certain eligibility requirements that a borrower must meet. In addition to that, there's a decision tool that's used to determine whether or not modification makes economic sense. And so, no, not all borrowers who would apply for HAMP modification, for example, or for any of these modifications would necessarily receive it. I think that the numbers, that there are closer to 3 million borrowers who either applied for or and were not provided a HAMP modification, or if they got one, they subsequently had the modification canceled. So when you consider that number versus the number of currently permanent HAMP modifications, which is about 900,000, that'll give you a sense of the numbers of people that might have applied and not been approved, or been approved and been canceled.
Thanks a lot. Let's see, we have a question here via email. This comes from Peggy Lee, and Peggy asks, how much effect do you foresee the AG servicing guidelines having on modifications, etc.?
Well, that should have some beneficial effect. There has already been a movement towards standardization of modification, but the idea of having a single point of contact, for example, I think is a really important feature. I know that one of the reasons that you hear for modifications not going through or for cancellations is difficulty in the first place, difficulty in contacting borrowers. You also hear a lot about lost documentation. A single point of contact should help with that particular issue.
Thanks, and thank you for that question, Peggy. Our next question here, also via email, this person asks, how did GAO determine whether a loan modification was successful?
So we were looking at redefault rates, and so we looked at it in our econometric modeling, we generally were looking at redefault at 6 months. And so that would be that the borrower was 90 days or more delinquent 6 months after the modification became permanent. We also, in our modeling, looked again at 12 months and 18 months. And so the relationships that we report on in this report held true whether you were measuring redefault at the 6-month point in time, 12-month, or 18-month. But we're measuring success by not redefaulting.
Thanks. This next question also via email. This person asks, I am hearing news here and there about improvements in the housing market, but I'm not really seeing it myself. Can you talk about what you found with respect to the current state of the housing market?
Well, the way I would describe it, and by the way, we have a graphic in the report that shows where house prices have gone using private data. And essentially, you see a real drop-off in house prices, and it recovers a little bit, then comes back down. And we've seen this 3 times now. So you might be seeing some recent data that's showing improvements in house prices. We won't know whether we've hit the bottom until it's long past. So what it looks like is as if we're sort of skipping along the bottom right now.
All right. What about principal forgiveness? How are federal agencies using it, and what does it mean?
Well, federal agencies really aren't using principal forgiveness. They're prohibited from doing so in some cases. And they'll use something a little bit different. So FHA, for example, will do what it calls a partial claim. And what that means is that if there's the back due amount would be added to the end of the mortgage, so that when the mortgage is paid off or the house is sold, then that amount would be due. So that's what FHA does. They're focusing more on repayment plans and partial claims. Neither VA nor USDA does principal forgiveness. We also took a look at the GSEs are considering principal forgiveness. That is, their regulators taking a look at that possibility. It requires some analysis to see what the potential benefits might be in doing principal forgiveness. It's important to note that right now the data, there just isn't enough experience, I guess, with principal forgiveness to have conclusive evidence that principal forgiveness works. There's a lot of evidence that would suggest it should work and that it should be more effective than, say, principal forbearance and more effective than rate reduction or other methods. But there's just too few observations right now to conclude that conclusively.
Thanks for that. We have a question here via email from Carol. It's in 2 parts, so I'll ask the first, where she is looking for your comments. It seems like federal foreclosure programs ignore state-to-state differences in recourse laws and provide incentives to lenders that are out of line with what the lenders could expect to recover. They're paying lenders to forgive principal, which under many state laws the lender would not have recourse against the homeowner to collect. This seems like an overly broad structure and is a giveaway to lenders. Do you have any comments on that?
That's something we really didn't take a look at, is what impact the variation in recourse laws or redemption periods or some of these other state provisions in the foreclosure process, what impact that might have.
All right, so it's outside of the scope of this
Yeah.
inquiry. The second part of Carol's question is, are there federal foreclosure programs, whether administered by Treasury or the states, required, or are the programs required to comply with laws that prohibit providing federal, state, and local benefits to non-legal U.S. residents? And are programs doing this, or is anyone checking on this?
That's a good question. That's another thing that was not part of our scope.
All right, and we'll move on to the next question, which comes from Catherine via email. Catherine asks, what parts of the country may have started recovering significantly, if any, and which are still showing problems?
I think our map helps in a way. So that's giving you a sense of the proportion of mortgages in each of those states that we consider to be at risk. And The problems are still in those states that have had the greatest house price decline, for example. So Florida and Nevada lead the way.
I can pull that map back up too.
Followed quickly by Michigan. But there are some states which really did not suffer as much in terms of house price decline, like North and South Dakota. I think that the percent of loans at risk there are at 4% for each, or something along those lines.
Great. Our next question came via email as well. Have the federal efforts been more or less successful than those of the banks and private industry?
So we did take a look at using some of the proprietary data at redefault rates. And one thing that does stand out is that the redefault rate for FHA mortgages is significantly higher than redefault rates for non-FHA mortgages. So that's telling you something about how effective potentially that program is. So far as the other investors, that's something where the data was not particularly reliable in us trying to link with the specific investor and to try to use our econometric model to isolate the impact that who held the mortgage, who was the investor, might have had on redefault.
Thanks.
So what we have there is simply descriptive statistics.
Sure. Sorry to interrupt you there. We do have another question here. This one's from Abby, came in via email, and Abby asks, are there certain groups, for example the military, more at risk for foreclosures? Are there any laws in place to protect the military from foreclosures while they're deployed?
So we have separate work ongoing at GAO on this particular issue. That's not something we could model. The data wasn't there to tell us whether or not, for example, the borrower was an active duty service member. I can tell you we have currently underway work which is taking a look at protections for service members under the Service Member Civil Relief Act. And there are protections if you're active duty in terms of the foreclosure process. There's also protections in terms of what the maximum interest rate is that a lender may charge on your mortgage.
Thanks, and thanks for that question. The next question here, I keep hearing about borrowers being underwater. What does this mean, and is this a relatively new phenomenon?
It is a relatively new phenomenon. So underwater simply means that the homeowner owes more on the mortgage than the property is worth. And what has happened with house price declines of 32% nationally over a 6-year period means that for many borrowers, they now own a house which is worth less than what they owe on the mortgage. For some of these borrowers, they may have even put 20% down on their mortgage when it was first made and still be underwater, still owe more on the mortgage than the property is worth.
Another question here. This person asks, how much taxpayer money has been invested in these programs so far?
I don't have a total number. So for the HAMP program, which is the largest here, it was authorized, I think, $45 billion, and it's now at, I think, 29. The CBO's estimates are that it won't be using nearly that amount. So we really won't know for a while what the total cost is for the HAMP program. I think it's important to note that in the other federal efforts, like with FHA and VA and so forth, the idea here is to try to, and in all these modification programs, is to try to solve for what is an optimal solution in terms of cost to taxpayers and the likelihood of a borrower staying current on the mortgage. And this is where we think there's a lot more that FHA, VA, and USDA could do to try to solve for that. It really doesn't make sense to offer a solution which has a higher chance for the borrower to redefault. You really are looking for solutions that will increase the likelihood of redefault at the least cost to taxpayers.
Thanks. Um, GAO makes a range of recommendations in this report to a variety of different agencies. Can you talk a little bit about those recommendations and why they were different for different agencies?
So that's what I was just talking about a moment ago. So we think there's a lot more that FHA, VA, and USDA could do in terms of their data analysis and data collection. We have a strange situation here. We have FHA does not collect certain information like borrower income and expense data or LTV data when a loan is modified. So we recommend that they do collect that information. VA requires servicers to collect this information, but does not require them to report it to VA. We think it would make sense for VA to require those servicers to report it to VA. And USDA collects some of this information but doesn't analyze it and has some difficulties with their systems and matching data. So each one of them has sort of a little bit of a different problem with their data, and so our recommendations are intended to get at the particular problem that each faces. But the concept here is for each of them to take this information and assess whether or not their current policies and practices make sense, and if there's need for some adjustment to make those adjustments. We point out in the report that FHA, for example, the last time they really did this kind of analysis was in 1996. And as we all know, the world has changed quite a bit since then. So we think there's far more that these agencies can do to understand and rationalize their loan modification programs.
Thanks for that. We have a question here via email from Anne. She asks, what could the federal government be doing differently to better help struggling borrowers? You may have touched on that with the recommendations a little bit there, but can you expand at all?
Well, if they were to do this analysis, there could be a lot of changes that they would make to their programs. We think it does make sense for it to be driven by what the analysis might show. We also raise the question of whether or not principal forgiveness makes sense, and there's ongoing analysis on that front right now. We really, we asked a lot of different folks who work in this space whether or not there was something that we need to begin anew that hasn't been done before, and essentially what we got back was no, what we need to do is we don't need a new program, we need to find ways to make these existing programs work better. And so that's why our recommendations are focused where there are, and not to propose something that hasn't already been tried.
We have a second question from Peggy, who has followed up. She's asking about USDA's loss mitigation servicing practices. She's asking whether GAO has any plans to review those practices and current debt collection practices on delinquent mortgage loan accounts in a future report.
No, but it sounds, Peggy, like we probably should. That's something that I'll take a look at and see whether that makes sense.
Another question from Sarah. She asks, how did the agencies respond to GAO's recommendations?
So they all agreed, with one potential exception, and and that has to do with USDA. And there, they provided some additional information, and so we clarified our recommendations. So otherwise, I would say they all agreed with the recommendations.
And this question asks, how does this work fit in with GAO's work on duplicate and overlapping programs, if it does?
So we are, in fact, that's other work that I'm doing right now, looking at housing duplication within housing programs. And so there we do point out that the federal government has a number of efforts underway that provide support for for mortgage finance. And so this would be part of that. There's various tasks that each of these agencies undertake as part of their mortgage finance programs, whether it's in underwriting, whether it's monitoring their counterparties, whether it's servicers or others, and then what to do, what policies that they have in place at the end when loans fail, or for that matter, when they end up with, in most cases, with a property that they then need to manage and market.
And one final question. After looking through all of these programs, do you have any advice for struggling homeowners?
Well, there's a point of contact you can go to, and and if you go to the Making Home Affordable website for Treasury, so if you go to the Treasury's U.S. Treasury website and look for Making Home Affordable, that will point you in the right direction.
Great, thank you very much for that, and thank you everyone for tuning in. Thanks to everyone who submitted questions. We really appreciate it. We really value this opportunity to have this conversation with you. We hope to do this again soon in the future. Since this is kind of a new project for us, we are looking for any feedback, any comments that you might have about the format or things that we might consider. If you do have any thoughts, if you could please email them to askgaolive@gao.gov. We would really appreciate that. For more information on this report and all the other work GAO does, you can go to gao.gov. Our homepage always has the latest reports listed out front. You can also follow us on Twitter or on Facebook, twitter.com/USGAO. You can keep up with our newest reports and podcasts, that sort of thing. And on Facebook, same thing, facebook.com/USGAO. So thank you again, Matt, for taking the time. Thank you all for tuning in again, and we hope to see you next time.